Everything in this video is not intended as financial or investment advice. It is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. Price-wise, not too much has happened just yet on the digital assets side of things. Legacy getting very excited over AI and earnings, I guess. Potentially getting excited regarding inflation continuing to come down. But really the main primary focus has been debt ceiling talks, negotiations, jawboning and such. And we continue to fly closer and closer and closer to potentially defaulting on our debt. As a country, everyone says it's not going to happen. And yet here we are, days away. No one wants it to happen. But so far both sides have been unable to come to a consensus on a potential deal that has to also go through the Senate and the House. So just because the top people decide on a deal doesn't necessarily mean that it will pass. Hopefully you'd assume it would, the House and the Senate, but something to consider there as well. And this, of course, is throwing T-bills for a loop, as bills that are maturing around the X date have the most risk for delayed payment, which again has never happened before. So you're seeing some wonky yields around that date. As Justin Slaughter discusses here, the true date is a few days before the X date, because again, you have to get a deal finalized to actually get through the government, and that takes time. So the more we push this back, the closer we get to more and more issues, namely our credit rating as a country is also in question here. Get to that in a second, but this is the TGA as of last week. Wednesday had 116 billion. That has come down to around 60 billion, I think was the last number that I saw. We should get some more numbers at the end of the day today on what the TGA is down to, but Yellen has said anything below 50 billion is the danger zone. So we're getting closer and closer to the pre-danger zone and then the actual falling off a cliff where we can't pay our debt obligations. On top of that, we've also got Powell sort of saying, well, we'll probably pause here. We probably don't need any more hikes just yet. We're going to see how the hikes so far have had an effect on the market, on the data. I mean, if you look at any commodity type data, fertilizer, lumber, eggs, what else? Not sugar. I think that's one that's up, but I'd say 80 to 90% of the commodities year over year are down significantly and back to their pre-pandemic levels. Freight, shipping is another one. So it's probably reasonable to assess the situation here. The Fed, again, will also have a CPI print the day before the actual meeting. I doubt that alone will be enough to tip the scales, but potentially it's going to be something else people are focused on. So on Friday, Powell basically said, again, we're going to maybe pause, and then come Monday this week, Bullard comes out swinging saying, look, we need 2 more interest rate hikes in 2023, sooner rather than later. And his justification is adequate, assuming inflation is still high, which based on real-time estimates, it's coming down extremely quickly, and low unemployment, which certainly is low. But the question I always have is how lagging is the data realistically to even matter in the near term? And we're making future decisions based on ultra lagging data. If it's the best we can do, it's the best we can do, but it's just not an ideal situation. So because of these comments, we saw meeting probabilities perk up a little bit as far as more hikes in June and July. This sent the DXY higher, the dollar index, and then sent crypto and gold lower. As I talked about in the Monday piece, post SVB, Bitcoin's become increasingly correlated with gold and almost uncorrelated completely with equities, NASDAQ, S&P. So even though we're seeing an extremely bullish NASDAQ and S&P relative to the rest of the world, we're not really getting that benefit on the crypto side of things, because in the moment we are acting like a digital gold. And if we look at DXY, it's had 3 really great weeks based on potentially rates going even higher. So what I'd watch for specifically here is any more Fed speak regarding whether or not we will continue raising, next month, June 14th. We also have a GDP print this week, preprint or whatever they want to call it, the initial numbers anyway. And that may also help tip the Fed's hand whether one way or the other. But we're back to this game of not only waiting for economic data prints to decide a direction, as well as the debt ceiling, which is adding to all of the other fun that's going on. So this is Truflation, nearing a 2 handle on a year-over-year basis, just absolutely getting crushed here. The Truflation data and the BLS government data, the differential, the main factor is the lagging housing component. So it may take 3 to 6 months to actually see this in CPI. CPI is currently at 4.9, but we may see a 2% Truflation print within the next 3 months. We'll certainly see a 2 handle most likely within the next week or so. And the S&P has really just been revving the engines here at this technical horizontal level. Got really excited, I think, on potential debt ceiling negotiations being over a couple days ago. Reality sort of setting in here now. And much like the argument for the Fed pivoting or pausing, if the S&P was perhaps less bullish than it has been, maybe that would push the government to actually act sooner. There's certainly an argument to be made that a bullish market picture means there's not as much pressure on the government to actually get something done here. I still think from a technical level, 40-40 is important to pay attention to. But the other thing to pay attention to is obviously if we get closer and closer to the debt ceiling and nothing's done, much like 2011, where we had credit rating downgrades and the ripple effects from that eventually get priced into the market. If we look at the S&P during the 2011 period, for me, the difference is we were in a not as bullish range as we are now. You could probably argue some sort of Wyckofian distribution. And August 1st, I think, is when the deal was reached. August 5th was when that credit downgrade hit. So we certainly don't look as bearish as this on a technical picture. But the traditional financial analysts are all saying, look, we might have a 20% down move in the S&P if we don't get this stuff figured out. Very similar to 2011. And gold in 2011 had a 20% move north, and it hit its all-time high at that time. And whereas here, we're not seeing that reaction from gold at all. So maybe I'm a little ahead of the game as far as what I'd want to see here, or maybe the Fed comments are just too much of a determining factor here on dollar strength. But there's certainly competing forces going on relative to expectations. The expectation for me is if things look bad in regards to the debt ceiling, gold should outperform risk. And if Bitcoin is following gold, Bitcoin should actually rise with it. But we haven't seen that just yet. Last night, this headline came across as far as Hong Kong actually going through with the trading of Bitcoin and Ethereum. And I think this is why the markets perked up last night. But I don't think this is going to be long-lived. I think this is a short-term rally so long as the DXY remains bullish. On-chain-wise, transaction counts remain extremely high on a relative basis, down from all-time highs slightly, but above any other level in any period dating back since inception. This is a massive jump in transactional activity. This is related to what I like to call, in order to not give it a negative connotation, transaction experimentation, where people are essentially messing around with NFT type transactions, which the protocol allows. It's totally fine. Some people call it graffiti. Some people call it necessary for the future of Bitcoin. We'll see where that debate ends up in 10 years from now, but it is increasing on-chain activity from a transactions perspective. Transactions waiting to be confirmed in the mempool, as it's called, has come down a bit here. We're not seeing this feeding frenzy of fees where everyone's racing to get their NFT transaction confirmed. That has come down quite a bit. Active addresses down. Like I said last week, because of that fee component rising, active addresses recovering slightly. But in general, you're not seeing breadth in users experimenting with NFTs. This is basically very few people on a broad basis because you're seeing a massive jump in transactions, active address is falling. We can also look at the inscriptions as they're called themselves and see over time, is there a trend here, rising, falling? It's down slightly from all-time highs. Fees paid is down significantly. Again, this is when the feeding frenzy occurred as far as trying to get your transaction through as quick as possible and being pressured to send an increased fee on those specific days. You can see approximately 40 million in fees sent to miners, so miner revenue was up in that period. I'll get to that in a second. And in general, I don't think inscriptions are going anywhere per se, but they've definitely cooled off slightly from earlier in the month. Looking at hash rate, this is the aggregate computing power of the entire network based on all miners in the network. Now, since inception, massive all-time high on a non-log scale, all-time high on a log scale as well, but it just looks a little different. If we put this on log, it almost looks asymptotic as far as going to a flat level eventually over time. But in this near term, we saw a bunch of infrastructure build-outs finish. We saw new ASICs get deployed. We're seeing various places around the world pop up as little tiny mining jurisdictions for specific reasons based around power supplies, and all that is getting baked in here. The good news for miners is because of the transactional activity, we are seeing uptrend for mining revenue, down from its peak. But if that transactional activity is here to stay, the uptrend in revenue should also continue to at least keep pace for the miners. On the technical side, again, not much has changed. I'm really kind of focused on this channel or pitchfork and really the 200-week moving average as well as the 200-day moving average. You've got a head and shoulders that has yet to break down here, likely somewhere to the 24K region. I will give it credit that thus far, it's been a couple weeks-ish, and we've kind of refused to break down just yet. So I still think the near term is bearish, certainly, but at least we're putting up a fight at the 200-week moving average. And based on the cloud, we are certainly near-term bearish as well, with an expectation to try to drift to the other edge of the cloud. You can see examples of that in March, in January, when you sort of traverse the cloud. These aren't slam dunk trades 100% of the time. Here's just an example again in November, pre-FTX blow up. But they usually have a pretty good hit rate and don't typically occur more than once a quarter. And it does say we're sort of resetting the bullish momentum. So from a long-term bullish perspective, you do want to see these retracements over time because that allows you to continue a reasonable rally. It allows people to get in the market that otherwise weren't and thought things were overvalued, that sort of thing. And looking at the weekly cloud, again, the cloud is a trend following indicator. And really, we've done best from a price perspective when we were above the weekly cloud. You can see the cycles here. And in 2016, we broke out of the cloud. In 2020, we broke out of that weekly cloud. And you can see we're getting closer, but we're not quite there yet. So this price action, has been great. It's beat the pants off of everything in the world for the most part, other than NVIDIA directly. But in reality, for me, this represents that pre-halving rally we typically have seen leading up to the big show. This is just people getting in the parking lot, finding their seats relative to the cyclical nature that we've had since 2014. We do have a halving coming up in 2024, which, similar to 2020, may align with the technical breakout here on the cloud. So I'm not going to expect any miracles in the near term for Bitcoin price-wise as far as moving to the upside. For ETH, also just as unexciting and muted. Unfortunately, I wish I had exciting things to say about ETH or Bitcoin every week. On-chain activity for ETH, still generally trending down. Again, I think it's very hard to beat the yield you're getting on ETH right now, whether it's 4%, whether it's 8% based on some estimates I'm seeing. It's hard to get better than that on ETH right now. So I don't think you're going to see ETH activity necessarily perk up. Additionally, as I mentioned every week, the layer 2 stuff, it's just cheaper to use Arbitrum, Optimism, than sending transactions through ETH directly. So that's also going to eventually level out where you'd expect layer 2 prices to increase over time eventually. And layer 1 here hit an equilibrium of sorts. If we look at the staking component. Since April 12th, ETH deposited for staking has essentially gone parabolic after staking became liquid. Currently around almost 23 million ETH being staked, and most of that is sitting in a service called Lido. From a centralization perspective, there are issues here because you really don't want to put all your eggs in one basket. You don't want all of the ETH in Lido. The problem is Lido is so good as a staking service that it just makes the most sense to send your ETH there. I believe it's the best yield amongst the group here. It isn't exactly as bad as it looks as far as the centralization component, but it could lead to a scenario where there are eventually issues with consensus should something happen on the Lido side of things. And another number that's important is since staking became liquid, ETH has added 1.7 million on the inflows side. So even despite all of that, you're just not seeing price react yet. And if we look at the percentage of the network that's staked according to staking rewards, we can look at all the staking coins here, stakeable coins, and amongst them ETH is on the lower end of the staking ratio. Something like Cardano, Solana, in the 60s and 70s, Avalanche even in the 60s. But as this continues to increase, it'll be interesting to see if eventually there's a price effect here. The other sort of maybe problem with staking is the financialization of it, in that you can stake your ETH and then use the staked ETH to lend. And now they're talking about protocol that restakes the ETH, and it just gets all very much CDO squared for me on the rehypothecation side of things. And the question is, what are we actually doing here? Are we just getting yield on yield on yield, or is there actual utility and activity that's happening on the chain? And I think that's something we'll hopefully see an uptick in down the road, but right now it's really all about staking. This is the Glassnode estimation for ROI per validator, somewhere around 4.2%, like I said. And the staking rewards estimate, somewhere around 8.8%-ish after the disinflation mechanism. But if we look at the pools here, or the nodes that you could participate in, most of them around 4 to 5%. So it's really kind of dependent on where you go. There's also MEV, which I'm not going to talk about, but additional ways to juice the yield. Looking at the ETH price, though, still in that range it's been in for a year now. Not much has changed, certainly near the top of the range. I like an eventual breakout for ETH, but until the regulatory side clears up in the US, I think it's going to remain sort of muted and unexciting. And lastly, just looking at volume broadly, zooming way out and looking at exchange volumes, some of this is stablecoin volume, USD volume, crypto volume. It's all the volumes, right? It's not just anything specific. Some of this is derivatives, but the point here is volumes have continued to decline month over month, really since late 2021, and the trend is certainly lower, and now we're sitting at a level that we really haven't seen since before the halving in 2020. And generally when we see low volumes like this, it is not a broadly bullish picture. So I'd love to see debt ceiling get cleared up. Would love to see the Fed have decent forward guidance one way or the other. And would love to see regulatory components in the US come in and clarify what businesses can and can't be doing, what users can and can't be doing, instead of just sort of picking off businesses and exchanges one by one. That's all for this one. This video is for informational purposes only, and the opinions expressed are not for financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.